Hey subscribers, thank you so much for joining me today. I am Jeremy, this is a financial education channel, and oh my goodness, how long has it been since I've done one of those full true intros, guys? It has been forever. So today I want to talk to you guys about 5 reasons why you don't want to buy a stock. 5 reasons that if I look at any of these 5 things and I see one of these happening, I will not touch that stock. I don't care how much the other things are going for that business. If it has one of these 5 things going on, I will not touch that stock, guys. So I hope you really enjoy this. Hope you learn a lot from it. By the way, if you're kind of newer to the stock market, make sure you check out that 3rd link in the description. That's my 11-part stock market investing mastery course. Even has a private email address to contact me if you have any questions in relation to the course. If you're more experienced investor with over $10,000 in the market, make sure you get in my stock market membership group. It's the first link down there in the description. Let's get into this, guys. Number 1 reason why you want to stay away from the stock is if you expect that business is not going to grow over the next 3 to 5 years, don't even think about getting in that business, okay? There is no such thing as a stagnant business. So let's say you're getting in a stock and you're like, I think they can probably just keep the business they have over the next 3 to 5 years. That's a bad reason to get in a stock. You want to be in stocks that over the next, 2, 3, 4, 5 years, you can see that business growing. You understand why that business will grow. You believe in that company and why they can grow because they're doing this, they're making this move, they're doing that and whatnot. If you can't see that, guys, don't mess around with that stock. There's so many stocks out there to invest in and so many companies that are expected to grow, heavily into the future. You don't want to be stuck in a stock that, they might just be able to keep their business stagnant or something like that. Like, if that's the case, just don't even invest in it, guys. Think about it. Like there's a great expression. You're either expanding your business or your business is dying. It's one of those two. There's no such thing. I've been in the stock market for 10 years. I don't ever remember a company that their revenues were the same every year. Their net income was the same every year. It is so unrealistic, guys. They're either growing or they're shrinking. It's one of the two, all right? The second reason is if that company is not profitable. If this is a corporation you're investing in and they're not profitable, you're taking a huge risk with that company, okay? Because a lot of the times these companies still have very big valuations on them. And yes, they could be profitable someday, but the fact is at the moment they're not profitable. I do not mess with unprofitable companies. The few I have messed with, well, one in particular, GoPro, that I messed with that was unprofitable absolutely slaughtered me, okay? You do not want to be in a company that is not profitable. Profits mean that company can use that money to expand into other things, okay? Profits mean that company can pay you out dividends or do share repurchases or something like that. Like, profits mean life for a company. Eventually, if a company keeps losing enough money, they're going to go out of business, okay? Or they're going to end up having to take out massive amounts of loans, massive amounts of debt in hopes that someday they can pay off those debts, and that would probably just drag the company down under, okay? You're taking a highly big risk if you're investing in unprofitable companies. I would never do that, guys. Just don't mess with it. It's not worth it. So many companies out there that are making great profits, that are growing phenomenal. It's not worth being in some company that's not even profitable. Reason number 3 is if the company went public in the last 12 months. Don't mess with companies that have IPO'd. Can you make some money in there? Yeah, sure. Sometimes you can get in a HUD IPO and it's just going up and up and up, and then next thing you know, it starts going down, okay? What ends up happening is a lot of times, here's what happens with IPOs. A management team of that company, a CEO, founder, and whatnot, sometimes, and this happens a lot. You see a ton, okay? They know their numbers are going to be strong when they're about to go on the IPO and, pitch it to Wall Street and whatnot. Here's why we want to go public. Here's our numbers. Look how strong they are. And they know that even like the next quarter or two will be really strong numbers, okay? So it means they can kind of hopefully have a smooth IPO. But what ends up happening is 1, 2, maybe 3 quarters down the road, they all of a sudden start reporting really weak results. Way less growth than what was expected. Numbers that are, not nearly what Wall Street has expected, not nearly what investors had expected, and all of a sudden you see a stock get absolutely cut in half almost immediately or within a few day period. That's what happens so often with these companies. Because think about it, from the perspective of a private, company, your life's so much easier, so much better usually, and then you want to take a company public. It's like, why you even want to take that company public? There's plenty of private money. There's plenty of private equity money out there if you want to raise more money, right? At the end of the day, there's plenty more out there. What happens is a lot of times these companies realize, we're starting to, our business is probably going to start weakening in the back half of this year or something like that, or our growth isn't going to look nearly as strong. So let's go ahead and take this company public now where the growth still looks really strong. We can command a really big valuation for it, and everything's going to look great at first, and then it's going to start going down. Don't mess with companies that have IPO'd recently. Also, these management teams, they're unproven, okay? It's one thing to prove yourself as a private company, but as a public company, it's a whole different ballgame, okay? As a private company, you make this mistake and that mistake, they can kind of just get swept under the rug. No one even knows about it except internal people who are probably in the management team as well. But as a public company, you make a mistake here, a mistake there, is gonna be publicized over everywhere, okay? All over the financial publications, and that could bring down your company more and more and more. It can weaken team morale. Don't mess with companies that have IPO'd in less than 12 months. Wait till they got some type of track record out there. You can see where their business is going. You can see how the management team performs as a public company, and then you can go ahead and get involved with that stock if you want. I would say just wait, guys. It happens so often. These people get slaughtered in these IPOs. They think they're going to make a ton of money, and they initially do make some money, and the next thing you know, stock's cut in half overnight or something like that. Reason number 4 is if the company is all defense and no offense, don't mess with that company, all right? The reason, now how you can tell this is by listening to conference calls, okay? Listen to conference calls. You can hear the tone of a conference call if it's all positive or all negative in relation to competitors, all right? If all the company's talking about is playing defense, if that's all they're talking about, they're just talking about playing defense and how they're gonna, keep market share and how they're gonna keep market share with this customer and that customer and not necessarily expand market share and expand into new customers. If they're not on the offense, don't mess with that company. Once again, this almost goes back to the point of companies that you don't expect to grow over the next 3 to 5 years. Companies that don't really expect to grow as far as their management team, board of directors, those type of companies are just talking all defense. They're just all defense. You don't want to be on a defensive corporation, okay? You don't want to just be on a company that it says, oh, our revenues last year were $5 billion. How do we just keep those revenues at $5 billion? Hell no. I want to be in companies that say, our revenue was $5 billion last year. How do we grow to $6 billion this year, or $7 billion this year, or $8 billion this year? What do we need to do to execute to hit those type of numbers? I like offensive corporations, not just defensive. Defense is like, okay, once again, you're stagnant, okay? You're just trying to keep your revenues at $5 billion. Guess what's probably going to happen? It's probably going to drop to 4.8 or 4.7 or 4.5 because you weren't focused on getting that new customer, growing market share. You were just focused on trying to keep all your other 100 customers, and guess what happened? 1 or 2 of those customers went bye-bye. There was nothing you could do there, and then you end up in a company that's shrinking, okay? And reason number 5 is if they have a weak brand name for their industry, I will not touch it, okay? When the companies I like have the strongest or one of the strongest brand names in their particular industry. When I just think about some of my biggest investments, their brand names are like the strongest in their industry, like Toll Brothers, like strongest name in house and home building as far as a premium end, okay? We could think about like, L Brands, obviously, the strongest brand name in underwear and bras. Like there's them and there's everybody else. Bath and Body Works, another brand they own, like that's a premium brand in soaps and candles and things like that. And then there's everybody else, all right? If I think about Callaway Golf, they're the number 1 brand name in all of golf, okay? They're the number 1 brand name in golf. If I think about Cirrus Logic, number 1 brand name in audio components that go into smartphones and iPads and all that type of stuff, okay? Number 1 brand name. There's them and there's everybody else, okay? I like to be in companies that are creme de la creme with brand name in their industry, okay? Especially if it's a consumer industry, okay? Something where you're selling items to average consumers out there. But even in business to business environment, like companies with strong brand names that are trusted. Because guess what? If they're trusted, they're well known, they're well liked, guess what? A lot more people are going to want to do business with them, and their business is likely going to expand over time, guys. So if any of these 5 reasons, come up with a stock and they meet some of these guys, you do not want to mess with those, in my opinion. It's just not worth it. It's not worth it. There's so many great companies to invest in out there that it's not worth investing in some companies that have some fatal flaws to them. Not even worth touching them, guys. So anyways, I hope you really enjoyed this today. I hope you learned a lot. Let me know in that comment section if you have anything to add. I would really enjoy to read those, guys. Thank you for watching. Have a great day.